Welcome to DWS Market Update. Almost all around the globe, economic data has weakened. Looking at the G7 nations, Japan and the UK dropped into a technical recession, Germany is close to one, and the French economy stagnated in the second half of last year. It looks like the Italian economy may have grown the fastest behind the United States over the last 2 quarters. But in any case, it was the US economy that has seen the strongest growth rates by far. Of course, that raises the question, why is the US doing better? For one, being independent in energy supply is helping a lot. But another difference is that fiscal policy in the US has been much more expansionary, which has contributed significantly to last year's growth. However, growth from this source does not come without side effects. According to calculations by the International Monetary Fund, the structural US budget deficit, so the number adjusted for cyclical influences, amounted to no less than 8.8% of GDP last year. It doesn't take a degree in economics to assume that this is not sustainable, especially in the context of a government debt level of over 120% of GDP. But there is another perspective. Last year's growth slowdown was not an accident, but it was deliberately brought about by central banks in order to push inflation lower again. While the decline in inflation in many countries has been somewhat faster than predicted, US inflation figures have recently come in higher than expected. This was not welcome news for the market. Yields rose and expectations of rapid interest rate cuts were revised significantly. As a result, the so-called Goldilocks scenario, so an environment of robust growth combined with low inflation and hence low interest rates, may come under scrutiny. It looks like markets might be up for some volatile weeks, even without headlines about the upcoming elections. That's it for today. Thanks for watching and goodbye.